Three tips that I have for you guys in investing. Number one is do the fundamental research. I think a lot of people these days are conditioned to just trade the next coin or thing that they've heard. The art of doing fundamental research has been almost lost. I think the money to make as a retail investor is actually investing with a longer time horizon, but you're taking a view over 1, 2, 3, 4 years. I would encourage you for companies to research and read the annual reports, read the quarterlies, read the conference call transcripts. If you can get your hands on sell-side broker research that the investment banks write about the companies, I would read that, understand how they're valuing the businesses, understand how they model the businesses and project future cash flows, and then understanding the competitive dynamics of the industry. Is this a good industry to invest in or a bad industry? How is this industry evolving over the next 3, 5, 10 years? Really at the core of why you buy something should be fundamentally driven research, where you think that there's a dislocation between the price you're able to buy that asset at and what the long-term value of that asset should be. My second piece of advice is don't be afraid to bet against the herd. I think a lot of the money is actually made buying things when they're unpopular or out of favor and then selling things when they're just too hot and too hyped. When you're looking at stocks that are trading at historic valuation lows that are getting no love, no attention, that's generally a pretty damn good time to buy. I'm contrarian, but I'm very macro informed. I pay a lot of attention to global M2 and just global liquidity. I pay a lot of attention to debt cycles. I pay a lot of attention to other, broader economic cycles. I pay attention to how currencies are reacting to each other and commodities are reacting and the relationship between Bitcoin and gold and, the US dollar and EM currencies. All these things matter really, but at the end of the day, when things get really bombed out or when they're getting no attention, it tends to be a pretty good time to buy them in general. And when things are really hot and going up into the right really hard, it tends to be a good idea to take some profits or rotate into other opportunities. It doesn't mean you can't ride momentum, by the way, but should just always be eyes wide open. The third piece of advice I have for investing is paying attention to liquidity. Liquidity matters a lot. The macroeconomic indicators that are available for the entire public to see, like global M2 and what the Fed's doing and all that kind of stuff, whether liquidity or it's going to be injected in the system or sucked out of the system, influences asset classes across the board, commodities, currencies, equities, debt, etc. So I pay enormous amounts of attention to what governments are doing with their balance sheets, what global liquidity metrics are looking like, and I use those as leading indicators of what speculative asset classes like Bitcoin, technology stocks. I tend to look at liquidity as a leading indicator of how those assets will perform. So I pay a lot of attention to how money's moving, but it's hard to fight against that wave. Like even when you find a company that's got an incredible investment opportunity and a long horizon, it might take years to realize that upside if it's not aligned well with global macro conditions.